Our good friend Garrison the Third from Preservation Financial Group always has great advice and tips for saving for retirement, and he is here today talking about a phenomenon that we need to hear about. And Davis, I want to welcome you back into Daytime today.
Thanks for having me, Chris.
Tell us what this phenomenon is, and it has to do with life insurance.
The phenomenon really has to do with life insurance or insurance companies as a whole. Through the years, there is no other financial organization or institution that has performed like life insurance companies have. It's because of the safeguards that are built into them. And life insurance or insurance companies are required by each state to maintain a certain reserve level. In other words, if you have, we've talked about income annuities, lifetime income annuities.
Right.
If you have $500,000 in a lifetime income annuity, they have to match dollar for dollar in their reserves. They have to keep that on hand. That's not true for any other institution, financial institution. Banks are required to keep 10% on reserve.
Just 10%.
Just 10%.
But they were required to keep an exact amount.
Exactly. Dollar for dollar. During the recession, the Great Recession or Depression, 1929 through 1938, 9,000 banks went under.
Right.
And in 2007, 2008, what they call the Great Recession that we've witnessed, 900 banks went out of business because they do not have to maintain that cash reserve, and it's each state dictates it. If a state or if an insurance company comes out with a new product, it has to be approved by 50 different states. So that's a whole lot of due diligence before they can even market a vehicle in the state. In 1949, the president of Metropolitan Life of New York, Leroy Lincoln, made a statement that said, and at the time, MetLife was the largest insurer in the world. And he said that in the financial industry, you are as protected with the largest insurance company as you are with the smallest insurance company. So those safeguards are in place. If you're looking to buy a life insurance policy, a lifetime income annuity, you need to look at the carrier, the insurance company's ratings. They're rated by S&P, Standard & Poor's, which gives us the S&P 500 index in the market. Also Moody's, AM Best. And you want to stay with an A-rated company. And the reason for that is because the levels of safety that are built in to life insurance contracts, annuities, disability contracts, that type of thing, they have a general fund that is managed very conservatively, and they also have the reserve requirements, dollar for dollar. And if an insurance company is rated B or lower, it means that they're taking too much investment risk with their general fund.
Okay.
And so the insurance companies are literally the most solid companies on the face of the earth because they have these requirements.
What do you encourage folks when they come to see you? What do you encourage them to do if they do not have life insurance when they come to see you?
There's never been a life insurance policy paid to a dead person.
Right.
So it is a living benefit. And if you have a couple, and this is an example I use, if you have a couple that have children, and say the husband is killed in a car wreck or something, those children have actually lost both parents because the wife, unless life insurance is in place, the wife is going to have to go to work to support the children. So the children are actually losing both parents. And so that's an analogy that I use to instill in people the value of life insurance. And life insurance, you are leveraging. You're buying dollars for pennies. And so that's the way that you need to look at it.
All right. Davis Garrison the Third, thank you for dropping by and giving us more great information about getting ready for retirement. That's what he's all about there. Preservation Financial Group there, 208 Sunset Drive. Go by there. Call him. He would love for you to call him today and come by and get ready for retirement.